Hello, my name's Richard Comotto. I conduct the ICMA European Repo Market Survey, and I've done that for the last 20 years. I'd like to present the results of the 41st survey, which took place on the 9th of June. I'm afraid it's taken quite a long time to finalize the survey due to bank staff having to work from home, and then with the return to work, having to catch up with a backlog of systems updates. But I'm very grateful to all bank staff who've worked so hard to provide the data for the latest survey. We've got to the point where we can give you the preliminary results of the survey. The final and full report should be available next week. As you can see, the headline number for the survey reached a record outstanding balance of euros 8.757 billion on the 9th of June. So this is an increase of 11.1% over the December survey and a year-on-year increase of 5.4%. Now, this is an aggregate number for 60 institutions. It therefore provides a floor for the true size of the European repo market. I should note that we don't include any repos done with central banks as part of monetary policy operations, and there's no adjusting for double counting where two reporting parties transact with each other. However, when we estimated the impact of double counting a few years ago, it was only in the order of 10 to 15%. Interestingly, this is a similar proportion to that found in SFTR. Now, in broad terms, the recovery in the market, which began in the second half of 2016, has continued, but it's accelerated over the last year. Now, that surge is in line with other evidence about market activity, for example, data from CCPs and trading venues. We can compare the ICMA survey numbers for the last two surveys with the numbers coming out of SFTR reporting. Now, I should note here that we've published a report on the first year of SFTR, which you can find on the ICMA website. Now, there are three surveys marked there. Ignore the first one, and the initial growth that you can see in the SFTR number for the EU28, that's probably due to the gradual rollout of reporting obligations and the gradual improvement in reporting efficiency rather than any underlying growth in the market. The December survey, so we put the total as 8.285 billion, whereas the EU28 under SFTR reported 14.237 billion. So the December survey was at 58% of the SFTR number. By June, that had decreased to 46% if you added the EU27 number to the UK number. Now, we'd always thought that the ICMA survey was about 80% of the European market. I don't think we're too wide of that market because both the ICMA and SFTR numbers seem to be similarly double counted, but the SFTR numbers we know are inflated by the way that CCP cleared repos are reported. And the June comparison is probably been distorted. The reason it's gone down, the survey has gone down from 58 to 46% of the combined SFTR number, is probably due to the duplication of trading with the establishment of EU offices by UK firms post-Brexit. The slide here shows the average daily turnover rather than the balance of outstanding transactions. Now, we've only recently started trying to measure turnover in the ICMA survey, and only about half of the survey sample currently contribute. But if we gross up the number of the contributors to reflect the size of the survey overall, it comes out about 2.3 trillion per day compared to the EU28 number in December, just before the Brexit transition period ended, of about 3.5 trillion, so 66%. So again, we think our numbers are pretty reliable as a measure of market size. If we dig into the data, we can analyze trading venues. Now, starting from the bottom, we can see that Triparty repo in Europe continues to be a relatively small share of the market, much smaller than in the US, where it is estimated to be up to 60% of the market. Now, this, of course, reflects the fact that Triparty is the normal method of collateral management in the US. It includes US Treasuries, whereas only about half of European Triparty is government bond collateral. Now, since 2015, European Triparty has also been weighed down by the ECB's QE. The COVID dash for cash provided a bit of a boost, but that had started to run off shortly afterwards. Now, by the way, the report of the latest survey that will be published next week includes a look back at the Triparty repo market over about the last 15 years, based on data both in the survey and that's been provided directly by the main Triparty agents. Okay, after Triparty, let's look at the share of voice brokers. Now, this has been in secular decline since the start of the survey, although the share of voice brokers occasionally rebounds, usually during periods of stress when they can help with the search for liquidity. The decline of voice brokers can be seen to be due partly, if not largely, to the growth of automatic interdealer trading. Platforms have come to dominate the market in commoditized, very short-term CCP cleared repos against government bonds. Now, that's pushed voice brokers into longer-term and more complex repos, notably forward repo. The share of automatic trading grew very rapidly to about 2012. Then it stabilized until 2016, and then it started to decline. But remember, this chart measures the share of automatic trading, not the value. The value has continued to grow fairly healthily. The leveling of automatic trading share probably reflects the impact of ECB intervention, starting with the LTROs at the end of 2011, going on to QE from 2015. This is because the type of business which dominates automatic trading, it tends to be very short-term transactions for interdealer financing, and so they will be hit by central bank intervention. Also, remember that it's very short-term, and we're looking at the outstanding business. Short-term transactions run off quickly, and so when you look at the outstanding balances, that tends to understate short-term business compared to if you'd looked at this in terms of turnover. Now, that takes us next to direct or OTC trading, and this is where we find longer-term structured repo, most credit collateral, and most customer business, including that on automated platforms such as TradeWeb or GMLX. Now, the share of direct trading has been an uptrend since 2012, and there was a very significant surge in that activity in 2016. We believe that some of the impetus has been regulation, which has forced banks to prioritize higher margin customer business over more commoditized interdealer transactions, and also the introduction of innovations such as evergreens, which tend to be OTC. More recently, we think automated dealer to customer trading, which is currently included in the direct total, that will have also contributed to the growth of this activity. This slide explains something about the evolution of Triparty repo. The red line is the headline number from the survey. The blue line is the total of Triparty repo reported to us by the principal Triparty agents in Europe. Now, we can use the survey number as a proxy for bilaterally managed repo. And there's two key features that this chart highlights. The first is the outperformance of Triparty relative to the survey from about 2011 to 2015. And the second is the underperformance of Triparty thereafter. Now, we believe the outperformance of Triparty reflects post-crisis diversification of funding by banks, the maturing of the Triparty repo product in Europe with the entry of new types of user, and the arrival in Europe of banks from jurisdictions less impacted by the great financial crisis and with more balance sheet to spare, but needing to find funding in currencies like euros. The underperformance of Triparty is after 2015, we put down to ECB QE. As a segment of the GC repo market, Triparty is crowded out by central bank liquidity. I should note that the volatility that you see in the Triparty series in 2011, 2012, which really interrupted a long-term growth after the great financial crisis, that's likely to have reflected early ECB intervention in the form of the LTROs. Now, the growth from 2016 in the survey, so the red line goes up, but the blue line stays flat. We think that reflects the success of banks in optimizing the new regulations, which started to really impact from about 2015, um, and but also the increase in specials trading as a result of QE. And of course, this would help the general survey number outpace the tri-party number. If we compare the value of automatic electronic trading, that's the blue line, with the survey, you can see that they are many times closely related. But it shows automatic trading gaining ground in the first half of the last decade as banks responded to cost pressures. It's cheaper to trade electronically, but also through their efforts to reduce risk through the increased use of CCP clearing. Now, that is typically accessed through automatic trading platforms. The chart also shows a jump, the effect of a jump in direct trading we saw earlier since 2016, which makes the blue line lag the red line. The spike in automatic trading in June 2020, of course, reflects the COVID dash for cash. In this slide, anonymous means CCP cleared repo. Now, this appears to have eaten into domestic markets, but the trade-off between the two may be coincidental. Now, while the share of anonymous trading's fallen since 2013, it needs to be remembered that most CCP cleared repos automatically traded, and automatic trading is largely limited to the very short term. Very short-term repos run off rapidly, and so looking at the market in terms of outstandings, as we mentioned, understates the importance of these repos. But clearly, CCP cleared repo has been less of a priority compared to other types of business since about 2013. So, if you like, risk has been off for various stages of this period. Cross-border business, the red line, has seen the biggest flows in the repo market and has really tended to increase its share over the second half of the survey period. If we look into the cross-border business and break it down, we can, due to the limitations on the data we can ask for in the survey, we can only ask whether the other counterparty is in the Eurozone or not. We don't know the location of the reporting party. So reporting parties who often are running regional or global books can say they've dealt with somebody inside or outside the Eurozone, but there's no sensible way often of measuring where they are. Now, we can see cross-border business into the Eurozone, which would include transactions by London counterparties, and that's increasing. Cross-border business outside the Eurozone would include transactions between London counterparties. But what all this means is rather difficult to interpret. In terms of currencies, as one would expect, the euro dominates, but its share has been eroded by the growth of other currencies, particularly the dollar and pound sterling, but also we see an increasing share of yen, some of which is related to cross-currency basis trades. Note that the drop in the share of the euro in 2019 largely reflects a surge in other currencies. The European repo market continues to be dominated by government bond collateral. Now, there was a drop in the share of govies after the great financial crisis due to the hoarding of core govies and the flight from peripherals. But central bank intervention restored stability, so the proportion went up. Then the surge you see after 2015, we think that reflects increased specials trading following the introduction of QE and growing scarcity in core Eurozone, in core government bonds of all types. The share of German collateral has fallen over the whole survey, and that largely reflects safe haven hoarding. It's been compensated to some degree by an increased use of French collateral. What we're starting to see perhaps more recently is the effect of increased issuance. In terms of peripheral Eurozone securities, if you look back at the start, Italian collateral was classic GC in the European repo market, accounted for 18% or more of the market. But of course, increasing concerns about credit quality have led to a decline, which reached its bottom in about 2011. There's been a recovery in the share of Italian collateral. There's a lot of it, and it used to offer a relatively high yield. It's fallen back more recently. We can see Spanish collateral fluctuates quite a lot in its use. Spanish banks have come into the market in phases to shore up their financing. And then we can see the other smaller peripheral Eurozone countries, notably the blue line for Greek collateral, which just collapsed in 2010 and has not yet recovered. But occasional recoveries in things like Irish and Portuguese as their credit standings improve. In terms of maturity analysis, European repo has quite an extended maturity profile. When we get out to over 12 months, the survey, I think, understates the true extent of this long-term repo business, because it's probably not on the books of the desks that report in the survey. But the bulk of the survey is short dates, and that's jumped in the latest survey from just under 51% to just under 58%. And if you look at the red line, so each of these clusters of columns is for a particular remaining term to maturity. And the red line on the right of each cluster is the latest survey. And you can see there's been a jump in short dates and a corresponding fall in maturities of 1 to 3 months, and to a lesser extent 3 to 6 months. Now, there is a strong seasonal pattern. When we do the December survey, the maturities lengthen as people look to ensure financing over the holiday period. And in June survey, we tend to then find the reverse is true. I'd also note the share of forward repo on the very right-hand side. That's almost got to 20% at various times. It's fallen right back. We feel that's probably because it's a means of managing future collateral, and that's been less of a problem in recent times. If we look more closely, if you look at the blue line, that's short dates, and you see the strong seasonal pattern there, briefly interrupted with during the Eurozone sovereign debt crisis. But you can see the short dates increasing in June and falling in December. And that's largely driven, if you look below, by the 1 day and the 2 day to 1 week business. If we look at 1 to 6 months, on the other hand, we see a strong cyclical pattern, but the other way. So this business peaks in December and falls back in June. And in the last survey in December, that jumped quite significantly. It should be emphasized that this bracket of business, 1 to 6 months, we see increasing evidence of collateral swaps, particularly at year end. So these tend to be typically done between 3 and 6 months in order to exceed the 1 month LCR boundary. And then we estimate the maximum and minimum weighted average maturities. We don't know the precise amount, but somewhere in this band. And you can see that the recent trend, well, at least until 2019, to try and increase maturities, that's been reversed quite sharply. And this, of course, is the effect of the COVID and the dash for cash. And then finally, we also ask participating repo desks to measure the securities lending they do from the desk, and it's fluctuated between just over 10% to almost 25%, and that's come back more strongly. And it's a measure of the integration between the two markets. Most of this repo lending on security desks will tend to be fixed income and things like cash rebate trades rather than anything too fancy. If you have any questions about the survey, please feel free to contact me. Otherwise, I'll direct you to the full and final report of the latest survey, which will be issued next week. Thank you.